There's still room for surprises in the last week of the ghost month as the market reacted positively to the Fed's announcement of a rate cut this September. Let's look into some highlights. My name is Den Slim, and welcome to another episode of Monday Market Outlook. So let's start with some economic news. Nomura Securities came out with some good news, projecting inflation to ease to less than 2% by the fourth quarter of this year, putting the full year inflation at 2.8% and projecting inflation to further ease to 2.3% by 2025. And this is even lower than the BSP's own projections of 3.4% and 3.1% next year. Hopefully, this could ease some pressures on our consumer stocks as they are already unable to pass on the increase on these input costs to consumers. With the recent spike in commodity prices such as coffee hitting all-time highs and cocoa prices ramping up again, it's no wonder that companies like URC and Monde are taking a hit from investors. Now, on the government spending side, infrastructure spending was up 17% in June. This could be a good sign for continued government spending to keep our GDP growth rate within the target range of 6%. And while it was a quiet economic week last week, the PSEi continued its rally, surging to 7,000 briefly before consolidating within the 6,900 to 7,000 range. Now, looking at the heat maps, the real estate stocks taking a backseat last week with the banking stocks taking on the spotlight for now. BDO and Metrobank up 9 and 8%, while BPI only up 4%, still reeling from the effects of the downweight on the PSE index rebalancing. Hopefully, the MSCI rebalancing could give BPI a boost this week. Now, Ascent pulling back 11%, Globe pulling back 4%. This could give buyers an opportunity to come in and buy these stocks. Now, going back to the PSEi charts, we are still on track to 7,135. Hopefully, completing the third wave of the Elliott Impulse wave, we could continue this rally when the markets open on Tuesday, but we also need to correct a bit as we are too extended already from the 20 AMA. Now remember that if we stay too far from the moving averages, we do tend to revert to the mean before a meaningful rally can continue. Now let's look at some index movers here. Ayala Corp breaking out of the 200-day EMA and even breaking out of the 630 resistance here. 660 could be our next target zone. SM grinding past the 61.8 Fibonacci level. Let's see if SN can move to 960 in the coming weeks. We have ASN pulling back close to our buy the dip zone. Let's see if it can hold this level, and this could be a good chance to buy into ASN. Globe pulling back, finally reverting to the mean. Could this be a good opportunity to buy, or should we wait for 2154 before buying into Globe? Talking about mean reversion, right? Now, let's take a look at the prospects for the market after this big run up. Currently, despite the rally, we can see that we are still about 2 standard deviations away from the 10-year average mean of 18.4 PE ratio. We are at 12.3, right? And the question here, when are we going to revert back to the mean in terms of the PE ratios? Look at the earnings. It's going aggressively up, but the market hasn't caught up with this yet. When will the market catch up? We've been trading at this level for what, 2 to 3 years already? Nobody knows. But I think it's the right time for investors to come in, because you don't want to be chasing the markets when the market finally makes its move. If the stock market is trading at very cheap valuations, let's try to find some of the cheapest stocks in the PSE. You can actually use a screener, and if you have TradingView, you can generate a rough list even if you are on the free tier. Now let's go to TradingView here, and you can go to the screener function here, and you can screen for stocks, right? Now in this case, We want to screen for Philippine stocks, so we have to choose PSE. So this is now a list of all of the stocks in the Philippine Stock Exchange. Right now, of course, we want to filter this into stocks using certain criteria. We want to have the big caps here. We don't want to trade penny stocks, right? So let's make sure that our stocks have a market capitalization of at least 20 billion. Now it's reduced to 92. Let's make sure that it has liquidity. So let's put in average volume for 10 days. Now we want the average volume for 10 days to be at around 50,000, right? So we'll apply that. So it's now reduced to around 62 stocks. Now we want to make sure that the stocks we select are trending upwards. So let's choose EMA, EMA 20, EMA 50, EMA 100, and EMA 200, right? Now we want to make sure that the 20-day EMA is below its price, right? So we select below. The 50 EMA is also below its price, below price, below price. So now we have 28 stocks in the PSE that is trending upwards with a market cap of at least 20 billion with an average volume of 50,000, right? So if we sort this in terms of the PE ratio, we can get the cheapest to the most expensive in the list. Now, using this, we can now highlight everything and then right click. You can add this to a watch list. You can create a new list here, PH bargains. And now you have a list of the stocks in the Philippine Stock Exchange that is trending upwards, sorted from cheapest to the most expensive at least. No? So we can add sections here, cheap, and we can identify here anything above 10 would be mid, so BDO. We can add a section here. We say mid priced, and we can have here 20 CNPF. We can add a section here and we can name it expensive. So these stocks, except for Keeper, because Keeper doesn't have a PE ratio here, these stocks are a bit on the expensive side, and you can actually consider these stocks when you are trying to open a position. You can even look at the charts of the stocks that you've selected at least 6 months, and then you can see that they are all trending upwards, some of them even forming some reversal patterns here. We can see here GT Cap, right? RCR has already had a good run up. Apex Mining also, SCC consolidation. Could be a reversal here. Metrobank, right? Pure Gold could be a reversal here. Ayala Corp also. Converge, already a big run up. BDO, still quite cheap actually. Of course, we want to be focusing on stocks with these filters, right? Because we want to ensure that the stock is trending. Now, if we reset these filters, we will get stocks that are actually trending downwards. And if we look back into the list here, you will get results like AEV or JGS. Here, if we look at AEV, right? What has AEV been doing for the past years? It's been trending downwards. They might be cheap, but when will this reverse, right? So remember, when getting into a stock, it's easier to trade with the trend. If you look at ICT, it's easier to trade this. You can buy here, you can buy here, you can buy here and still make money. But if you buy AEV or JGS, if you bought here thinking it was the bottom, it just went lower, right? So don't buy into a stock that looks like this with the hopes that it will discontinue something, right, that it has been doing for a long time. What's the catalyst for this to reverse? I mean, a lot of people are talking about Bloom, right? Let's look at Bloom. People are saying this is a good support, it will bounce off of that, right? Yes, I mean, I agree, it will bounce off of that. And unless it has a fundamental catalyst for it to continue going up, this bounce here will just eventually be met with sell demand. So remember that when you're trading, don't trade against the trend, because the trend is your friend until it bends. Let's look at the long-term PSEi charts. The markets have actually been in a bargain price mode for what, 2 to 3 years, right? When will we revert back to the mean? Again, nobody knows. And ever since we topped 9,000 back in 2018, the PSEi has been struggling ever since. And it's really only lately that we're seeing some potential economic catalyst for a market run. Again, GDP is healthy. Company earnings are actually back and has even surpassed pre-pandemic levels. So it may just be a matter of time before we start hitting these levels soon, right? So meanwhile, in the US, jobs data threw another curveball with the jobs growth revision numbers last week showing the largest downward revision since 2009. So basically, the jobs numbers we've been getting for the past, 7 months were off by around 818,000, right? But despite the major revision, this was actually largely expected by the markets. The trends for the labor market still appears to be positive, especially on Friday after Fed Jerome Powell all but confirmed the September rate cuts 3 weeks from now during his key speech at the Jackson Hole in Wyoming. Now, the time has come for policy to adjust. How dramatic can you get? Wow, the time has come, right? Now, this sent the clearest signal that the Fed is prepared to start the easing cycle, and markets saw this as a declaration that the central bank's fight against inflation is over and that the economy no longer needs a restrictive policy. Now, how big a rate cut is now the key question. After the speech, markets currently pricing in a 63.5% chance of a 25 basis point rate cut with a 36.5% chance of a 50-point rate cut in September. This sent the S&P 500 rallying to 5,635 to end the week on the third straight week of gains. Now, the S&P 500 did manage to fill this gap fill here, hitting this critical weekly resistance zone at 5,600. The past 4 days saw a consolidation along this zone, and all signs still point towards another attempt at breaking new all-time highs. No? So the market has actually had a great run right after the labor data flash crash here. And this run up here is actually the fastest 10% rally from a correction low ever, no, for the markets. Now, what an exciting time to be in the S&P 500. Now, if we draw a Fibonacci chart, assuming that this is the peak and this is the trough, we see that the 38 and the 61 fib actually corresponds to these gap fills here. Now, you might be wondering how we determine these critical zones here. Let me show you what you can also do to determine some horizontal support lines, no? And one way really is to look at multiple time frames. If you look at the labels here, we have daily, monthly, and weekly. Now, let's go to the monthly and I'll show you, right? On the monthly charts, we can see some levels here that are quite significant for the market. So we have a low here. Remember that in this case, right, in this particular case, where the candle closes or opens is more important than the wicks, right? So we have here a monthly level here and here. We have a monthly level here. We have a monthly level here, right? See, month. Remember, we have to finish the time frame first before we can mark it. This is a monthly time frame, so we have to finish August before we can see where this candle will close, right? Now, if we go to the weeklies, we can see the weekly levels here. There's a weekly close at this level. There's a weekly close at this level here, which corresponds to this resistance. There's a weekly support here, weekly support. There's a weekly support here. See where the candle closes, even if there's a big wick here. And this was where the weekly resistance sits during its previous peak, which we have now broken through. Now we go to the daily charts. We can see the daily resistances. We have the daily levels here, the daily support here, daily support 1 and 2. We have more support on the daily and more support here on the dailies, right? So At this point, you can now see which of the levels here have more confluence, right? So we know that this is actually a very strong zone here, because we have the daily, the weekly, the monthly is all converging here. Zooming in to the current situation here, we have the gap fill here at the 38 fib, but the gap fill here at 5,350 makes more sense, as it's where the weekly, the daily, the monthly, even the 61.8 fib sits. So if the market does pull back, it could potentially hit 5,350 in the coming weeks. Now, when will that happen? Let's try to look at some historical charts. The 8-day win streak of the Nasdaq and the S&P 500 actually was the fastest rally from a correction low ever, where the average was 32. The market recovered in just 8 days. This brought the current market sentiment back to a 51.6% bullish, quite close to the one-year high of 52.9, with bearish sentiment way below its normal range of 31%. This puts the bull-bear spread to a point where it previously signified some sort of a market top. So it does make the case for the S&P 500 to pull back in the next few weeks to bring us back into more normal ranges of around 0 to 10%. Let's take a look at the average performance per day of the S&P 500, and August does tend to be the weakest month, followed by September. And if you look at this stretch in September, could we get our pullback on the S&P 500 on these days? After which we do get the seasonal rally once we reach the last quarter of the year. So is August and September the worst months of the year? So far, we've seen this year's August to be quite volatile. 1% moves either way, favoring the gain side. Is September going to be a down month for us? And will October actually be worse? We will find out soon, right? But for this week, GDP numbers on Thursday and the core PSEi numbers on Friday for the US. It is going to be another shortened trading week for the Philippine markets. And I hope you are all enjoying your long vacation. Thank you for tuning in with me. Now remember, it's not too late to take some profits off of your positions. Remember that price action will eventually revert back to the mean if it's overextended from the moving averages. So enjoy your gains, right? So that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week. Bye-bye.